Thank you for joining us for today's webinar. It is the Financial Tips from Behavioral Economists. The point to cover here, we try to provide a lot of informational topics and educational aspects from all types of different contributors. Today we're going to cover the decisions that investors make during times of economic changes. And you can see we're going to discuss the role of behavioral finance, cognitive biases. We are happy to have M. Scott Niederjohn, is a Dean of School of Business and Entrepreneurship and Charlotte and Walter Kohler Charitable Trust Professor of Economics at Lakeland University in Wisconsin. He's also Director of Lakeland Center for Economic Education. He's published more than 50 articles, monographs, reports, curriculum materials, and journals such as Applied Economics, Monthly Labor Review, Journal of Urban Affairs, Eastern Economics, Journal of Private Enterprise, and others as well. His research is concentrated in areas of economic education, public policy, and applied microeconomics. We're happy to have Scott here. We always happy to have different points of view and provide our clients with a nice change from not only technical analysis, but some other types of outlook as well. And just remember, one lucky attendee will be selected to win the Lime Duffel Bag at the end of the presentation. So guys, just stay here to the end. We'll pick a lucky winner as well. Before we get started, I just have a brief disclosure that we would have to run here. So if you just hold on one moment here for me. So here we go. It is the Financial Tips from Behavioral Economists. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we're not endorsing any specific trading strategies. Security, derivative, and futures trading involves a substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Lion Brokerage LLC. Lion Brokerage LLC is not affiliated with these third-party market commentators, educationers, or service providers. Data, information, and material content are provided for informational, educational purposes only. This content neither is nor should be construed as made as an offer, solicitation, or recommendation to buy or sell securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lion Brokerage LLC does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, educators, or service providers, and any information used to execute any trading strategies is solely based on the independent analysis of the user. Thank you for that. I know it's a mouthful. For anyone looking to open a new account or try a demo of the Lightspeed Trader software or any of our other trading platforms, please feel free to reach out. My name is Rob Lipson. You can reach me at rlipson@linebrokerage.com. You can call our number, email our main numbers as well. So please feel free to poke around our website, look at the material we provide and the resources, and we're happy to help. Again, here's Scott's bio. We are going to turn over the presentation to Scott. We're very happy to have Scott Niederjohn as the presenter here today. Everyone else, just keep in mind here, we will have the presentation recorded on our website under our live webinars tab. This is where you can also view any of our upcoming presentations as well and our previous recordings as well. So this one will be on the website as well as some of the upcoming ones here as well. So please take a look at the website. You can try a demo, you can open the account and contact us here. So thank you guys very much. I'm going to hand the presentation over to Scott and he will get started here. We're very happy to have him and have you guys here as well. So Scott, you should be able to take over right now and get started.
Okay, yeah, thanks Rob, and thanks everybody for attending today. You should see my screen now as opposed to Rob's. And the topic today that I would like to talk a little bit about is this concept of behavioral economics and how we can apply that to many things in life, but particularly to investment decisions. Obviously, given the craziness right now, you know this more than I do. I didn't plan to show this slide, except I can't just ignore the current situation. Obviously, it had a nice bounce back the last couple of days, but there's no doubt that, given, as the Economists put it, the world essentially closed, the United States and really the world economies are certain to enter recession soon. As you know, the United States has been in its longest expansion in our history, more than 10 years, as you can see there from the GDP data. But obviously that's going to come to an end certainly this quarter and probably next as well. Again, I'm not necessarily an economic forecaster, but you can see on the right, I just posted something from the Wall Street Journal with some various pessimistic and optimistic forecasts, but even the pessimistic certainly shows a large increase, maybe a doubling of the unemployment rate here in the near future, and a very large decrease in GDP. So that obviously, as you know, and I think you did a previous webinar on kind of macro statistics, but our normal convention being 2 quarters in a row of declining real GDP is almost certainly going to happen here soon. So with that said, I hope that today's topic isn't necessarily on that, but I do think it might be interesting, just some tools maybe for you to think about anytime really, and I think in life as well as in investing, but also as we start to come out of this, or as you have to make decisions with your own investments. I think some of the tools from behavioral finance and behavioral economics might be of interest to you. So let's do that. Now, I've got a couple of things that I've never done it via webinar, but I want to do a little thought experiment here. I'm going to ask you to use the question area to sort of give me some feedback sometime. So let's start with this though. I want you to imagine a game or an activity that might be played or take place in, say, a large classroom or a lecture room, and envision that there's 2 groups of people. So one group of people we'll refer to as proposers, and one group we'll refer to as responders. And I want you to think about this carefully and think about how you'd behave if you were in either group. So let me just describe how this might work though. So the proposer would be someone who you might imagine has a real stack of $100, 100 $1 bills, and their job is to propose some kind of a split of the $100. So it could be they propose to a responder 50-50, or they could propose 80-20. That is, they keep 80, they give away 20 to the responder, 90-10, whatever. That's completely up to them. The responder's job then is to say, yeah, I'll accept this or I won't. So accept or reject. The trick, however, is that if it's rejected, both parties get 0. So let's just think about this again, just real carefully, because I'm going to ask you to sort of give me some feedback. The proposer's job, and this is all anonymous. Let's say we're in a room, I would take all the proposers' proposals and I distribute them randomly, and no one would know who proposed to whom. So if you reject or you don't, you wouldn't know who you're rejecting or accepting from. And proposers have no idea who's getting their offer either. So again, let's think about it this way. If you're a proposer, you got $100, a real $100 sitting in front of you, and your job is to say, how can we split this? Like I said, it could be 60-40, 50-50, whatever you want to do. So think for a minute about what you might do in that situation. And then secondly, if you're the responder, you need to say either accept or reject. And if you reject, then not only do you not get any money, but neither does the proposer. So let's go to the next slide. As you're thinking about that, and that little character there kind of shows a summary, would you just jot down, or some of you, would you please put it in the question and answer area? If you were the proposer, just give me some examples of what you might do. So you could write into this thing 50-50, you could write in 60-40, you could write in 70-30. What would you do? So I see some 50s, I see 60-40, I see 51-40. Okay, so a lot of 70-30, 40-60. Okay, that's interesting, and that's pretty normal. Now, would you do this for me too? If you were the responder, the person who has to accept one of these or not, would you please type in any numbers of which you would reject below it? So if you don't get at least X, you're rejecting. That might be $20, it could be 30, it could be 10, 50, I don't know. But are there numbers below which you would reject? So I'm seeing 60, 50, 20, 50, 40. Okay, That's helpful, and that's pretty normal. In fact, let's just move forward here. You showed me your offers. I saw those. So a lot of them are 60-40 or 50-50. People often do that because you don't want to have it rejected, right? So you want something that people consider to be fair. And then what we reject below, so I saw a lot of numbers. I saw some people say as high as 50, but maybe put 20 or 30 or things like that. But if we want to think about this really carefully, if you're completely rational, you really should accept anything, shouldn't you? I mean, $5 is better than 0, so why wouldn't 95.5 be okay? Frankly, I think I would take anything because anything's better than 0 and it's just basically free money. But your responses are pretty common. In fact, this has been done hundreds of times with lots of different groups. And the most common results is that people offer, the average result is a 60-40 offer, but the mode, or the most common split, is 50-50. And maybe surprisingly, maybe not, about 20% of low offers, that is anything below 50-50, is rejected. But just think about that carefully. To an economist, that's sort of irrational, because it's sort of saying, I want to punish somebody else for the bad offer, but in doing so, you're punishing yourself, right? So the only way to punish somebody is to punish somebody else, is to punish yourself, right? You have to say, I won't take free money. So in many cases, like economics would suggest, we're normally into maximizing things, being rational, not doing stuff to hurt yourself. But this experiment, and I think your data showed it, and data from lots of groups shows this, people often don't think about it that way because they care about fairness. I can't show this video because it doesn't work right via our connection here, but you might want to watch this later this afternoon when we're done. This is on YouTube, and it's called the Capuchin Monkey Fairness Experiment. So it turns out that not just do humans care about fairness, which is, I can't talk to you, but I'm guessing if I would have asked you why would you reject, say, below 40 or 30, whatever you chose, you would say because it's unfair. If somebody's trying to take advantage of me, I don't appreciate that. That's unfair, even though the way you punish them is by hurting yourself, essentially, by giving away free money. But in this experiment, there's these two monkeys in cages, and if they do a task, the task usually is to give them a rock. You give them a rock, they give it back to you, and they give them a piece of cucumber. They're happy to do the experiment over and over and over again. But if one monkey gets a grape, the other one gets a cucumber for doing the same task, the one who was finding the cucumber before will actually whip it back at the scientist. They won't accept it anymore. They'll throw it at him because they don't like the inequity either. So they find that to be, quote, unfair, right? Even though cucumber was just fine for the task up until they saw some inequity or some difference. So I think the point for you guys of this is that humans aren't always completely rational. And we're going to look at a few examples of that particularly relate to investment decisions. So behavioral finance, what's the role? So it's pretty well established field in finance. There's this theory that you probably are aware of, and I'm guessing given what you guys do, you probably don't completely subscribe to it, but let's at least talk about it for a minute. This thing called the efficient market hypothesis, essentially is well established in finance, and it says that it's really hard to beat the market because there's really millions of investors out there. Many of them spend their entire lives studying one stock or one sector. Price of stocks are maybe not today, but we've seen a lot of panic activities recently, but stocks are generally pretty efficient. They adjust to new information. It would be hard to sort of short-term make profits. That's what the efficient market hypothesis would say. And as you probably know, Burton Malky is well known for this, and you can watch him talk about that. He wrote that well-known book called The Random Walk Down Wall Street. Well, if that's true, then it would be hard to imagine lots of things working, that some things which you might actually do, right? So historical stock prices really should be irrelevant because the future only depends on new information, not on things that happened in the past. So I'm giving you some implications for those who believe in this theory. Or fundamental analysis, that normally means the kind of stuff that I help run a game in Wisconsin where high school kids invest fictional money called the stock market simulation. It's probably one in your state too, and your kids might have played it. Well, we try to teach kids how to research companies, understand future cash flows, understand their future prospects. Well, again, if you really are a slave to, or you really believe in the efficient market hypothesis, that probably doesn't matter much, because the only thing that should matter is new information, right? Everybody knows that stuff. Everyone can look that up themselves. So the point being that these guys would say, at least, is that stocks are essentially random, and that's why they would normally say, you know, invest in index mutual funds because you can't beat the market anyway, so why pay fees? Is what is sort of their normal conclusion. And are they right? Well, there's some reason to think they're pretty good. They might be right, because it is true that index funds have often beaten in history managed funds, right? So if that's true, in fact, you see that funny quote down there from Dr. Maliki. He's had people just randomly pick stocks by throwing darts at them, and they sometimes in many years beat the well-known fund managers. So if that's true, they would argue this theory makes sense and people are rational, and there's really no point in trying to beat the market. However, there's lots of reasons to disagree with it, and you probably are aware of a lot of these. For some reason, small firms tend to have higher returns, even after adjusting for risk. We tend to have higher returns in January. On average, the best returns are on Fridays and the worst are on Mondays. Maybe like what's going on right now, sometimes we seem to have overreactions to news or to information. Like right now, we've got a lot of volatility going on. And some people, like Warren Buffett, seem to be able to beat the market consistently. So this cartoon, which is silly, but it suggests that maybe if you believe in the EMH, you're kind of burying your head in the sand, and you're kind of ignoring the fact that that theory has a lot to do with humans always being completely rational when maybe they aren't. So let's look at how that might matter. Behavioral finance is really a subfield of behavioral economics. And what we're trying to do with this field is combine not only economics and finance, but also psychology. So it might be that the way people behave isn't always completely rational like you might find in an economics textbook, but it's influenced by other stuff. So this theory proposes people are often irrational, and these biases, which I'll show you a few biases in a minute, might affect the behavior of both investors and investment professionals. And in fact, there was a clever book written by a gentleman, an economist at Duke, called Predictably Irrational. His point being that not only are people irrational, we know when they're going to be irrational, because there are some certain situations where it's pretty common that happens. So if these things are predictable, we should try to use them. That's what I'm going to try to show you. And I see somebody mentioned some game theory from games, and that's often way that economists test their behavioral economics theories is through game theory, right? So that's one way to think about that, is to run experiments. In fact, the Ultimatum game that I kind of described earlier is really a game theory application, and the results are different depending upon whether or not you play it multiple times, for example, or if you eventually find out who the responder is, right? Because then that changes, you have a reputation effect. So really, these are all game theory sort of ideas that are being applied to behavioral economics. There's been a lot of Nobel Prizes in economics awarded to behavioral economists or behavioral finance folks recently. In 2017, in fact, Richard Thaler, who's in the School of Business near Chicago, won it. And his quote's an interesting one. He basically says, if you want to do good economics, or I would submit do good finance or do good investments, you better keep in mind people are human. I'm an economist, and it's true that our textbooks sometimes seem to ignore that, right? They seem to suggest that we're all these little rational optimizers out there. We always weigh costs and benefits. We always make good decisions, or the best decision we can. If that isn't true, then that might have an effect on the kinds of things you're trying to do, or the models that people like me as economists try to build. Other economists, you're probably familiar with Robert Shiller, because the Shiller Home Index is a thing that he created with another economist. I'll mention Daniel Kahneman later. He's a psychologist, actually. He's still alive, he's at Princeton, but his partner was a gentleman named Amos Tversky, and the two of them are two Israeli-born psychologists who really invented behavioral economics. And they did that really in the 70s. Tversky since passed away, but Michael Lewis, the famous author who wrote like Moneyball or The Big Short, wrote about these guys in a recent book that I'll show you at the end. Okay, so econs. They're in textbooks, and they're the kind of folks who like to very carefully weigh costs and benefits before making decisions. But humans tend to use costs and benefits, but other things tend to influence us. So, for example, if we think about two systems of decision making, the human one, and you can think about whether this, if you know, it explains your behavior oftentimes, we tend to be sometimes emotional, right? We do things quickly. We might be impulsive. We might be short-sighted. Whereas the econ, the one that you read about in a book, tends to be someone who's analytical and deliberative, patient, right? Because they're weighing costs and benefits and trying to make the best choice. We're probably a mix of the two. And again, if that's true, there's probably some ways we could learn a few things that might help us think about financial markets or really other decisions in life. So what are some of these biases? Well, there's a well-known one called loss aversion. Many of you have probably seen the movie or read the book called Moneyball. It was about the Oakland A's general manager, Billy Beane. And the book's really about the fact how he's able to exploit sort of inefficiencies in baseball to help the A's win. But he famously says in that book, I hate losing even more than I want to win. And that's, in a sense, what we mean by loss aversion. So it turns out that most humans tend to weigh losses more than gains. That is, losing something makes you twice as miserable as how happy you'd be from getting the same thing. And there's a couple of famous examples of that I'll describe to you. One that's been done many, many times is you give half the room, say you walk into a room, you're in an experiment, and half the room is given a coffee mug, and the other half of the group is given, say, $5 or $6. And then they're asked to essentially, those who have the money try to buy the coffee mugs and vice versa, or sell, other ones sell. And when they're asked to value the coffee mugs, those who were given a mug tend to say it's worth about $4.50, and those who weren't given one aren't willing to bid anything more than $2.25. And this has been a very consistent finding, and this is done over and over again with different groups of different ages and different kinds of people. And the explanation is that if you've been given it first, losing it's hard because you've already got it. So that's called loss aversion. You don't want to give it up. I think an even more poignant example was done with Duke basketball. You may or may not know a lot about Duke basketball, but they obviously, they're really good and they sell out their Cameron Stadium every game. Therefore, every student can't go. So what they do is they have students camp out at night before the games to try to secure tickets. And it's essentially a random drawing. So everyone who's out there camping out obviously is similar. They all want to go. They want to go enough. They're willing to camp out overnight outside, but they can't give them to everybody. So randomly they distribute tickets to some who are, to a group that is out overnight, and some don't get it, of course. An economist set the experiment up like this, and then he asked those who did receive the tickets, who got them, he started calling them up and saying, how much would he sell them for? And amazingly, some of the kids said there's no price. And he said, well, that can't be right. How about $15,000? So eventually, yeah, he came to a price, but in many cases, it was something like $6,000 or $7,000. And then he asked those who didn't get them what they would pay. And they kind of said, I'd love to go, but Washington sports bar is pretty fun too. And they made normal bids. I don't pay up to $100 or $150. There was a massive difference. And how do you explain that? The explanation that most come up with is it's loss aversion. Once you have them, selling them is like losing something, right? So it's worth more to you once you have it than if you don't. So even though that seems irrational, it's this idea of losing something that's really hard for people. So let's look at another little idea here. I'm going to ask you to also jot down some things, and then I'm going to ask you to type them in as well. So look at this scenario. So I want you to jot down whether you'd want option A or B. Let me explain these to you. So here's the way this will work. In addition to whatever you already have, I'm going to give you $1,000, and then you must choose either A or B. So you get the 1,000 for sure, and then option A, if you want that one, is it's 50-50 chance that you win 1,000 more. Or you may choose option B and you get 500 for sure. So would you prefer, everybody has 1,000, but then would you prefer option A where you've got a 50-50 chance of 1,000 more or zero, right? Or would you prefer to win 500 for sure? So just please jot down on a piece of paper in your mind, think to yourself, do I want option A or option B? I'll let you look at it for a second so you can see it. Now, let's do this one more time, And again, you're gonna have to choose A or B. So in a minute, once you've seen scenario 2, I'm gonna ask you to type in your answers into the question area. So here's scenario 2. Jot down an A or B again. In addition to whatever you own, so this time you've been given 2,000 though, and you can choose one of 2 options. A 50-50 chance to lose $1,000, or you lose 500 for sure. So this time you get $2,000 for sure, but then you can either take the chance, a 50-50 chance to lose 1,000, or you can lose 500 for sure. So you should have, I would like you to type in, you could be, you wanted A both times, maybe you wanted A and then B, or B and then A, or B and then B. But just, would you please, just a few of you type in what you wanted. Do you want A both times, or B both times, or A and then B, or B and then A, whatever it is. I want to see those so we can talk about that for a second. So hopefully you're typing in some responses here. So again, here's scenario 1, and there's scenario 2. And I'm not seeing any typed in, am I? Oh, here I go. I see. So I see a BA, AB, AA, AB, BB, AB, BA. Okay. Now, if you typed in 2 different letters, I'm not trying to insult you. It doesn't make a lot of sense, because that's what most people do. Most people want option B in the first scenario, the sure 1,500, but most want option A in scenario 2. They want to gamble. But if you think about this carefully, option A is the same both times. It's $1,000 or $2,000, 50-50, right? In both cases, it's the exact same offer. It's a gamble. It's either you get 1,000 or 2,000, and it's 50-50 which you get. And in scenario 2, in both offers, in both scenario 1 and scenario 2, offer B is identical. In both cases, it's a sure 1,500. It's either 1,000 plus 500 or 2,000 minus 500. But in either way, it's a sure 1,500. So scenario 1 and scenario 2 are identical. Henceforth, you should really, if you're completely rational, either you want A or B. You want A if you're into gambling. You want B if you're risk averse, probably, right? But you shouldn't choose one of the, you shouldn't change your selection based on the way I wrote my question, because they're the same. And I know most people do that. I'm not trying to insult you if you did that, but just think about it that way, that it doesn't make a lot of sense to change, because really it's the exact same thing both ways. But why do people do that? Well, maybe loss aversion, right? No one likes the offer where you have to deliberately give away money, and that's what the second scenario had, was lose 500 for sure. Most people don't like that very much, right? So that's one possibility. Or regret, right? Or probably not you guys, but many groups just aren't very good at probability, so they have a hard time working out sort of the chances here. But again, this is one more example of the fact that people may not always make completely rational decisions, and if that's true, we want to understand that. So it's the old transitive property. If A is better than B, there's no way B can be better than A, but that's how most people look at this. So we feel more pain of loss if we were close to avoiding it. This is Dan Ariely. He's at Duke. He's the one that did the basketball experiment. He said happiness frequently depends not on where we are at the moment, but how easily we perceive we might be elsewhere or in another better situation. So if you miss a flight by 45 minutes, people will say, oh, that's terrible, my misery index is pretty high. If they miss it by 1 minute, they say they're even worse. They say the misery index is very high. Again, does that make any sense? You missed it either way, right? Your life is no better because you missed it by 45 minutes or 1 minute, but people don't perceive things that way. They feel like, hey, I just missed this, so it's worse for me. Look at this example. I would much prefer to be person number two there, the one whose portfolio falls from 3 million to 2.5. But when people are asked to rate this, they're much happier in scenario A, right? But again, that probably isn't rational, but you can see why that may be the case, because nobody likes to lose things, and that's kind of the situation here. So how can we apply that to what you guys do? I think a key here, let me try to get my slide to advance, sorry. Oh, so a key here is that in finance, loss aversion could lead to irrational decisions in investing. It may be that investors refuse to sell loss-making investments in the hope of making their money back, right? So it can be hard. People seem more willing to take, quote, take profits when things are going up, than they are to sell losing investments because they want to make their money back. But again, that's not rational. If you're going to lose more money, you probably want to get out. So just the fact that you're losing something is not a reason not to sell, right? And this is true across asset categories. I mean, people often want to say, I can't sell my house for this because I paid this for it. What you paid for your home is completely irrelevant the day after you close, right? No one cares. Only you care. That is not the price that the house is worth anymore. It's just what you paid for it. So to anchor in your mind the fact that you must get back to what you paid for something really isn't rational. I do this myself, gambling. I play blackjack. When I'm in Las Vegas, I love getting ahead, and then I push a little pile to the right. That's the one that is like my profit, and the other pile is my, my what I invested originally. And I treat them differently. I'm more aggressive with the money that is quote profit, and I'm less aggressive when I get into that little pile of money, which is the one that I started with. But how does that make any sense? It's all my money, right? So why should I treat it any differently? Because I don't like losses, right? I'm loss averse perhaps, and I see losing gains not as painful as actually losing my money. So the key economists, think a lot about opportunity cost. That is, what's the next best alternative? Maybe you should sell a loss-making investment if you could use that money somewhere more productively. And some cost is this concept of don't cry over spilled milk, right? What you paid for something only mattered when you paid for it. The fact that you paid something for a share of stock a year ago is completely irrelevant now. The question now is, what is it worth, right? That's a sunk cost. It's already happened. It's the same reason why if you go to a movie and it's terrible, you should probably just leave, right? Because you're not getting your money back. Why waste more time? So that's sort of an implication for finance of this idea of loss aversion. Anchoring is another cognitive bias. So an anchor is a bias where you rely too much on the information that you actually know or has been given to you. I'm doing this webinar right now from Milwaukee, Wisconsin, and we've done an experiment where we asked people from Chicago how big Milwaukee is, and almost always the guess is around 1 million. And their logic is, Chicago's about 3 million. I know Milwaukee's smaller, so I'm going to guess 1/3 of Chicago. So how about 1 million people? People in Green Bay, Wisconsin, north of Milwaukee, we asked them how big Milwaukee is, and they'll say, well, I know how big Green Bay is, about 100,000. I know Milwaukee's bigger. They triple it, and they say maybe 300,000. Well, it turns out it's right between the two. How big Chicago is or how big Green Bay is completely irrelevant to how big Milwaukee is. It has nothing to do with each other, right? But your anchor, what you know, is where you live, right? So people tend to use that. Now, take a look at this little graphic here. You can probably see, here that there's 3 options the Economist magazine offered for people to buy their magazine. Let's call them A, B, and C. So A is economist.com for $59. Option B is just a print for $125, or option C is print and web for $125. One of those seems ridiculous, right? You might think to yourself, who in the world would buy what I'm calling option B, just print? And it turns out when a study was done, an experiment was done with a bunch of MIT students, 16% wanted option A, none wanted option B, and then 84% wanted option C. Well, it's interesting, and it's predictable, I think. However, why do you suppose the Economist deliberately put in option B? Well, take a look at this. If you remove option B, look what happens. Now, substantially less people take the print and web, and many more take just online. So many more choose the cheaper option. So they don't want to, they want to drive us to the more expensive one, so that's why they include option B. And the point from our perspective is option B is like an anchor, right? If 125 for print's a good deal, then what an amazing deal to get print and web for 125, right? So they deliberately anchor in your mind that 125 is a good price for print, so what an amazing price it must be for both, right? So obviously, given the results of this study, it affected with behavior, right? They see option B as like an anchor as a reasonable price, and therefore get people to buy the more expensive option. So that's what they're doing there. So what about other options, other things like that? Well, charities, they often give you a range of things you could donate, because what they're trying to say to you, they're trying to anchor in your mind that anything below 100 would be embarrassing, right? So you've got to give at least that, because that's the lowest number on the choice. or there was a famous study done with New York City cab drivers. The tip had been about, on average, 8.7%. Then they installed in their machines a suggestion, which was either 20, 25, or 30%. Just by doing this, by giving these suggestions, the tip increased substantially. The idea being they presented an anchor to your mind that 20% is the kind of low end there. You shouldn't go below that, and people tend to follow that. Well, how does that affect finance? Well, from an investment perspective, an obvious anchor is the recent price of a share or the price you might have paid for something, right? So many people make their decisions based on that number in their mind. What was the price they paid? And they're waiting to get back to break even. But again, that's just an anchor price, right? Does that really matter in terms of the future? People often sell too early, or they buy after a steep fall again because they're anchored to some price. But really, as you know, an investment decision should really be based on whether or not the price is trading at a discount relative to today's value, not some past value that you paid for it. That's really an irrelevant thing, what price you paid for it back in the past. That's really, to an economist, a sunk cost. That shouldn't have anything to do with your future decision making, right? But anchors are hard to get out of our minds. It's hard for us not to think about with our own homes, what did I pay for? I don't want to sell for less than what I paid, or my gambling example, or other things like that. Default bias, so this is the last one I'm going to show you, and then we'll just list a few more off. But default bias is this idea that people stick with what's been given to them. So let me show you two scenarios here. I want you to read these. I'll read them to you, but just think about them as I read them. So scenario one, option one says, welcome to Fund Corp Company. As a new employee, we are pleased to offer you a retirement savings plan. The company will match your contributions to your savings plan dollar for dollar up to 5% of your annual salary. Please contact the Human Resources Department, extension 52, should you wish to contribute to a savings plan. So this is like an offer to be in the company's 401k. So that's option one. Just to kick it on for a minute, let me show you option two now. Option two says, welcome to Fund Corp Company. As a new employee, we are pleased to offer you a retirement savings plan. The company will match your contributions to your savings plan for dollar up to 5% of your annual salary. In 2 weeks, we will automatically begin deducting 5% from your paycheck, match it with another 5%, and deposit the sum into your retirement savings account unless you contact HR at extension 52 and request otherwise. Okay, so they're similar, right? There's only a subtle difference between the two. So if we look at this, are the two offers the same monetarily? Yeah, of course they are, right? In both cases, they're explaining they'll deduct 5% and match it if you want to be in the 401k. Do they communicate the same information? Yeah, again, they explain that this is how the 401k works. This is where the HR department is, and this is how the program works. But do you think that you'll get a different response if you do this using option one or option two? And I'm guessing you do think that, and in fact, you would be right. If you don't automatically enroll, about 37% of people will put themselves into their 401k. But if you do, almost 86% of people do. And this is perhaps the most famous finding from the behavioral economist, Richard Thaler, the gentleman I mentioned before, who is at the University of Chicago's business school. He actually did this research and then got the Congress to change the law. So now we do allow companies to default you into the 401k. You can obviously, of course, get out. However, just by opting us in, we tend to have a lot more saving going on among Americans than if we had to do it ourselves. But so again, the bias here is that people default to what they already have. They don't put the effort into changing, and that may be true with investments or other things like that too. There's a few more biases. I won't go through them carefully. You can look up to these yourself. But one called confirmation bias. That's the idea that people seek out information and data that confirms their own ideas, and they tend to ignore contrary information. That's common in politics, right? People seek out something that confirms what they think is right. But it's also true in investing, right? If you're sure something's going to go up or down, then you may spend your time trying to find evidence to confirm your ideas, not being open to the fact that you could be wrong. So that's a common bias. Recency bias, I've been trying to think about that one today. Our tendency to believe that something is likely to happen again because it occurred in the recent past. Well, and the inverse is also true. If it hasn't happened for a long time, we tend to think there's very little chance it's going to happen again now. So that can have to do with, the market's been rising or falling. Will it continue to do that because of what you know? I've been thinking about that a little bit related to today's situation. The Federal Reserve, as you know, has been taking action, but a lot of their actions have been the ones they used when they were trying to fight a financial crisis back in 07, 08, 09, which was different. Though it wasn't a public health outbreak, right? It was a banking collapse, banking system issue, and toxic debt and things. So the question might be, is that the solution for today's problem, or are they just relying on the solution that they most recently used and seemed to work then? And then there's this thing called the bandwagon or herd mentality. I'm sure you're aware of that. It just basically says investors shouldn't blindly copy others, right? Even famous people, right? You shouldn't be influenced by emotion or by what others are doing, but rather you should care about your own independent analysis. So if you want to learn a little more about these topics, there's been some great books written recently, and many of them are really popular press type books that are very easy to read. Nudge is the term, I've talked about him now 3 times, Richard Thaler, the guy in Chicago. Nudge to him means, can we move people in a direction subtly to make better choices, like to get people to do their 401k contributions just by opting them in. So he calls himself a libertarian paternalist. He says we should always have choices, but the paternalist part is maybe we can help people make better choices if we just push them in the better direction. So it's a pretty interesting book. He gives through lots of examples. Many of them are investment related. Other ones are just in life or in other aspects of the economy. I mentioned Dan Ariely, who's at Duke. He also writes for the Wall Street Journal sometimes. So he's written this book called Predictably Irrational, kind of a clever title. The idea being that we know humans make irrational choices. I think I showed a few along the way here. So given we know that, how can we benefit from that? Or how can we help them make better choices knowing when they often make mistakes? The third book there is very much trying to apply these concepts directly to money and to investing. So why people that are in most of their life smart make money mistakes that could be solved by these behavioral economy insights. The last book is really my favorite. I'm a big fan of Michael Lewis's. He's just a really good writer. As I mentioned before, you probably may have read Moneyball or The Big Short, or other books that he's written. But this one's really a great story of sort of where this field came from and the stories of these 2 psychologists named Danny Kahneman and Amos Tversky, and he documents many of their interesting experiments, and many of them have to do with money and how humans tend to make some predictably wrong mistakes there, much like the ones that we did along the way here, like the example with A and B. People really should see that the 2 options are identical. So in summary, I'm an economist, and most of the theories we teach in our classes rest on some assumption of rationality. That is, that people make the best choices they can given the situation, and they would never purposely do something that hurts themselves, right? But behavioral economists often question that, and I think the Ultimatum Game shows that, because many of you were willing to hurt yourself. Many of you said you'd reject 50-50 and below that, right? So you wouldn't take $50 for free because you want to punish somebody else for making an offer that you don't think is fair. So a lot of these biases, it turns out, really do apply to the financial field, like loss aversion or anchoring or confirmation bias, the recency bias or bandwagon effect. So I hope that you might be interested enough to try to learn a little more about these topics and think about them, and see if they can help you with the kind of stuff you're trying to do in terms of either in decision making in life or certainly in your investment world. So with that, I'm happy to take any questions you might have about behavioral economics or anything else you think I can help with in terms of economics in general. Let me see what we got here. Can you explain, sorry to see that, sorry. Can you explain to the economists why people play slot machines? Well, I would guess the answer to that is because they are expecting, they see the big possible payout, right? Whereas playing blackjack to make any money at that is a long slog usually that requires perhaps hours of work, and there is no jackpot to make. But I think people see the short-term easy dollar from if they hit the big money on the slot machine. That's what they think they're going for. And I think they and again, people aren't very good at probability, right? That's one of the most famous things that the behavioralists have shown through experiment after experiment is people are not very good at probability theory. They don't understand risks. They have a hard time evaluating the likelihood of things happening. So they may just not fully understand how long the odds are in a slot machine, much like the lottery, right? It's the same kind of thing. Also, the books. You want to see the books again? Let me go back one. Sorry. Here they are. So here are the 4 books. There are others too, but these are the 4 I think would be the most readable. The famous Daniel Kahneman, the gentleman who won the Nobel Prize, he also wrote a book I have on my shelf here called Thinking Fast and Slow. And if you really want to get into something, you could read that. So again, it's called Thinking Fast and Slow by Danny Kahneman. But I think the challenge is with that one, it's really pretty technical because he really summarizes his many years of academic research. I think I see here it says there are good chances to make consistent profits as traders. I mean, I don't know the answer to that, but that's what I was trying to say earlier is those who believe in the efficient market hypothesis, and there are many. I mean, that's probably a predominant view among academic economists and finance professor types. They would say no, right? That's hard because, I mean, to make an above average profit, that is. Of course, the market goes up over time. That's been well established. And I think everybody knows that. However, they would argue it's hard to make what they would call arbitrage or quick profits or that kind of thing. However, I think the behavioral economists would say maybe not so fast because they are always thinking about rationality. That isn't what you always find. Any good book or paper options? Any good paper or book options? Sorry, behavior book. Well, I think I'll show you some books. In terms of papers, all of these same people, Richard Thaler or Dan Ariely or Daniel Kahneman, the ones that are in this PowerPoint, which I'm sure you can access later, all of them, of course, have published more technical journal articles that you could certainly go query in any kind of an academic database or even just through Google. I think you'll bring up some very well-known studies. But the point of these books, like Nudge, for example, Thaler essentially summarizes in layman's terms his 25, 30 years of research and puts it in simple terms, which is why I think it's a more efficient way to learn a lot about this stuff than to go read the actual journal articles. But if you want to know more about the actual research, you can certainly do it that way. Looks like that was the last question I see here. Oh, econs. Stock market versus. So you're saying stock market versus high frequency trading or econs. I'm not sure I understand the question. But I think the idea behind that, if you're thinking about the slide I gave you, yeah, so maybe the high frequency traders are trying to apply this theory, that's human. The question is always these two systems of decision making, econ versus human, right? So if we always assume that everyone is a quote an econ, a maximizer, a very careful, deliberative thinker, we're probably going to have models that aren't very predictable because people don't always behave that way. And I think the last few days probably show that, right? You get panic selling, you get people doing things that aren't, quote, rational. And since I think the reason why I thought you might find this interesting is because if we know that, and you already knew it, but now maybe you know more about it, maybe you can benefit from that, right? So think about how people would behave in certain situations that aren't always going to be rational, and maybe you can try to be rational and benefit from that. Okay, I think that's all I see here in terms of questions. I didn't include it, but let me just say this right now. My email address is my last name, so Niederjohn, N-I-E-D-E-R-J-O-H-N, and then MS, like Matthew Scott, so Niederjohn MS at lakeland.edu. So I work at Lakeland University, so Niederjohn MS at lakeland.edu. Feel free to email me if you have other questions or if you'd like me to send you these slides or other things that might be helpful to you. Just go ahead and reach out. I'm happy to help if that would be helpful to you, or send you some other ideas for books as well if you've got some other topics you care to learn more about. But I hope this was helpful to you. Looks like a lot of you thought so. So thanks for that, and I hope you have a great day, and I hope you hope we continue to have days in the markets like we've had the last two.
Thank you very much, Scott. We appreciate the presentation. I hope everyone got a little bit of insight on different outlooks on the markets here. Just to wrap it up, we're going to do our quick raffle here. Just going to pick someone random that's still attached here. And we have Christina Dunn. If you're still with us here, Christina, please type in the question box the address, and we'll send you out the lime duffel bag if you're still here. No one will be able to see if you type it in the question box. Oh, she's here. Okay, great, guys. Sorry, Christina is the winner. I'll follow up. I'll get the address and we'll send that out. But guys, thank you for attending, and be sure to be on the lookout for our future webinars as well. We have several posted and several more to come. So thank you very much. Everyone stay safe and be well. Thank you very much. Christina, I will email you and get the address for you, okay? Thank you.